If you're new to investing, you've probably heard the term ETF mentioned frequently. In this video, we'll explain what ETFs are, how they work, and why many long-term investors use them as a foundation for building wealth. Let's start with the basics. What exactly is an ETF? The letters stand for Exchange Traded Fund. It might sound complex, but the concept is actually quite simple and powerful. Imagine a shopping basket. Instead of filling it with groceries, you fill it with a wide variety of investments, like shares in different companies or perhaps bonds. An ETF is like that basket. It's a single fund that bundles together dozens, hundreds, or even thousands of individual investments. So, when you buy a share of an ETF, you're not just buying into one company, you're buying a small piece of every single investment held inside that basket. This brings us to one of the primary benefits: instant diversification. Instead of putting all your eggs in one basket by buying shares in just one company, an ETF spreads your investment across many. If one company in the fund doesn't perform well, its impact is cushioned by all the others. This is a fundamental principle of managing investment risk, and ETFs make it incredibly accessible. The exchange-traded part of the name is also key. It means the fund is bought and sold on a stock exchange, just like a share in a single company, say Apple or Microsoft. This allows you to buy or sell your ETF shares at any point during the market's trading hours at a price that updates in real time. This flexibility and ease of access are major reasons why ETFs have become so popular with investors of all experience levels. In essence, they combine the diversification of a traditional fund with the trading simplicity of a stock. So what's the secret behind the immense popularity of ETFs? While there are several advantages, one of the most significant is a powerful concept called diversification. You've likely heard the old saying, "Don't put all your eggs in one basket." In the world of investing, this wisdom is absolutely fundamental. Diversification is the practical application of that principle. Imagine you invest all your money in a single company. If that company thrives, you do well. But if it struggles or even fails, your entire investment is at risk. An ETF, on the other hand, doesn't just buy one company's stock. It buys a whole collection of them, sometimes hundreds or even thousands, all bundled together into a single tradable fund. By spreading your investment across this wide array of companies, you automatically reduce the impact of any single one performing poorly. This is precisely why ETFs are often recommended for those new to investing. Picking individual stocks that will outperform the market is incredibly difficult. It requires extensive research, a deep understanding of financial statements, and a lot of time to monitor each company's performance. With an ETF, you bypass much of that complexity. Instead of betting on the success of one specific horse in the race, you're essentially betting on the race itself. This built-in diversification makes ETFs a simpler, more accessible, and often less volatile way to gain exposure to the stock market, allowing you to build a robust portfolio without needing to become a full-time stock analyst. There are many types of ETFs, including index ETFs, which track entire markets like the FTSE 100 or S&P 500, global ETFs, which invest across countries, sector ETFs focused on industries like technology or healthcare. Most long-term investors begin with broad, low-cost index ETFs. ETFs can be bought and sold through investment platforms, just like individual stocks. Many investors use ETFs for long-term investing, monthly investing plans, retirement, and ISA investing. What matters most is consistency over time, rather than trying to time the market. So, after exploring how they work, their costs, and their risks, we arrive at the crucial question: are ETFs right for beginners? For a vast number of people starting their investment journey, the answer is a resounding yes. ETFs offer a remarkably balanced and accessible entry point into the world of investing. Their core strengths align perfectly with the needs of a new investor. Firstly, they provide instant diversification. Instead of facing the daunting task of researching and picking individual stocks, you can buy a single broad market ETF and own a small piece of hundreds or even thousands of companies at once. This automatically spreads your risk, a fundamental principle of sound investing. Secondly, they are incredibly simple to understand and manage. You don't need to be a financial analyst to grasp the concept of tracking a major index like the S&P 500. Furthermore, ETFs are widely available through almost any online broker and are designed for long-term growth, making them ideal for goals like retirement planning. Their low-cost nature means more of your money is working for you over the long run, rather than being eroded by high fees. However, simplicity does not mean a lack of responsibility. As with all investments, it's vital to do your own research and understand the specific risks of any ETF you consider. The value of your investment can go down as well as up. The key is to define your goals, understand your own tolerance for risk, and invest at a pace that suits your personal financial situation. For a beginner, starting small and investing consistently is often a far more powerful strategy than trying to time the market. If you're interested in investing in ETFs, beginner-friendly investment platforms are linked in the description. Always take time to research and choose the option that best aligns with your goals.